Thanks, Andrew. Morning, everyone. Okay, so we'll try not to do a Peppa Pig moment as Boris did the other day. The hand of history is upon us, so Tony Blair once said. And the mining industry carries the hope of the world. For many, you would be excused for not fully respecting this, given the general rhetoric and the fact that mining wasn't even included in the COP26 programme. But it does carry the capability to deliver the transition to a sustainable future. And the opportunity for this room, the stakeholders of the industry and the world at large is out there for the taking. It does so, though, from a position so deeply damaged that there needs to be a new beginning for an industry as old as industry itself. The backdrop, though, is quite exciting. BHP's forecasts see the need in the next 30 years to double copper production, increase nickel output 4 times, and produce twice as much steel as consumed in the last 30 years. The industry will continue to dig holes, explore in challenging areas of the world, and engage with communities, NGOs, governments all around this great planet. But if these fundamental pillars of output growth and mining are to coexist, then it needs to be financed in a new world of investment. From where we stand today, and with no exaggeration, this is looking increasingly challenging for those that require outside financing. Alongside oil and gas, mining is the worst perceived industry on the planet. Perception of brown industries is seeing growing cost of capital. A recent Bank of America report outlines that oil and gas longer dated debt is now less prevalent and new issue coupons are 50 to 70 basis points higher than investment grade. The same report also highlighted the increasing spread of cost of capital within material-based companies, from those that are high emitters to those that are not. The winds of change are upon us. But how big is this, and are we in a bubble or are we just starting out? Let's put it in numbers. Year to date, emerging markets have seen 25% of all bond flows have gone into ESG. In Western Europe, that's a whopping 63%. That amounts to $275 billion. In the USA, I accept it's just 4%, but think of the total aggregate when this starts to catch up. It's already at $90 billion, and the trend is exponential. It's estimated that $173 trillion of investment is required by 2050 to address climate change in both energy and infrastructure. This year, we'll see $3 trillion worth of green and labelled bonds issued. We're only at the starting blocks of this process, not at the end. I should just add that green and labelled bonds is a huge opportunity for the mining industry. The mining industry has only raised $4 billion of green bonds to date. It's effectively frozen out, and there's no reason why that is the case. What happens in the bond market is also being replicated in equities. 1 in 8 funds are now ESG. There are 3 times more funds under management in ESG than there were in January last year. And the inflows, again, remain exponential. The mining sector must start to differentiate itself. It must find a means to credibly prove its actions are real. It must demonstrate a new modern attractiveness for investment if we are to avoid a sector-wide increase in the cost of capital, and increasing exclusion from mainstream investment. We've got to start changing the old narrative. I hear many of you in this room thinking that this is just not possible, that the sector will just continue to bumble along as it has for decades and centuries. The world needs our resources, and thus it will all sort itself out. Small companies won't be affected like the same as the big ones. That's wrong. Doors are closing. Talk to the brokers in London and Europe who are already seeing that taking place with the investments they're taking around investment managers. A particular example that I heard last week was a first-hand story from the head of mining at a major Australian lender to the sector, that they are no longer putting any extractive companies through their credit committees. And the reason they gave that was reputation. They just don't have sufficient credible data to present against NGO claims. Given the very scale of this changing landscape, the big picture is clear. ESG has gone mainstream. A changing investment landscape and capital flows will increasingly restrict investment to those sectors and/or companies that cannot credibly demonstrate a commitment to a sustainable operation. Well beyond just emissions. It's just easier for them to say no. So the mining industry, though, has been changing for decades. Regulations since the BRIEX days in the 90s have shown huge improvements in governance. Health and safety improvements are lauded across other sectors. Water management is well established in many jurisdictions, and social engagement have shown many positive steps in recent years. But all this has gone largely unnoticed, except within the industry itself. But here's the key. ESG, in all its different clothes, is also a communication tool. A tool that, if the data is credible, can begin to promote an industry for the very good that it does through critical products it produces, for the engagement and investment in communities it provides, for the jobs it creates, and ultimately for the planning of a long-term sustainable ecosystem well beyond that of a mine itself. Hindsight is a wonderful position, but if I may just give you a real-life example of the opportunity ESG presents. Central Asia Metals, who I think are talking in just a minute, announced a tailings spill in September 2020. The share price fell immediately 20%. They handled the issues, as I understand it, on the ground in the same they would have done before. But this time they communicated openly and transparently with their stakeholders and their shareholders, turning a potential PR disaster into a positive with enhanced reputation and a share price that recovered quickly. So having explained the scale, we need to understand some of the changes which will impact mining companies on a day-to-day basis. Firstly, this is going to affect every company, private or public, big or small. Larger companies, as seen by virtually every investor presentation these days, are already fully engaged. Short and long-term strategies are being overhauled. Policies and procedures are evolving constantly to keep up with the changes. Capital allocation is directly impacted, and financing strategies are now directly influenced by sustainability functions. Secondly, investors are responding to a regulatory drive to divert capital to businesses that will help rewire the economy to address climate-related challenges. In the UK, for example, the regulators are redefining the role of the investment industry, incorporating the need to deliver socially useful value as part of the investment process. Your Rolodex of fund manager contacts, so often prizedly guarded, should now be supplemented with stewardship teams. There are 3 in this relationship now, not just 2. If this was just access to capital, then this would be easier to understand. But the lens of ESG reaches beyond finance to impact stakeholder expectations across the entire value chain. Access to market for end products and social license to operate are becoming increasingly dependent on ESG data as the rules of the game on carbon intensity change. And the valuation of your company will become increasingly linked to the measurement of this and other ESG topics. Most company managers in this room will likely be able to hold their heads up high when it comes to social license, and quite rightly. The mining industry has been ahead of the curve on this going forward. The mining industry has been ahead of this. But going forward, stakeholder engagement in this area will become more public. There will be greater demands on the company to become more transparent, which raises both opportunities and possible threats. But transparency allows the company to build trust and provides a platform for engagement with a wider range of stakeholders, including NGOs and other potential activists. Perhaps the area most challenging to acknowledge for an exploration company, let alone the world which requires the difficult to find resources, will be knowing how far this discussion goes when it comes to access to market. Will the cost of capital for a mine that requires a long supply chain or high-emitting processing be an obstacle for financing relative to other assets nearer to market or for a cleaner process? I focused on the negative here, but the opposite is equally true at the other end of the spectrum. For an exploration company where you may be located, identify the options available early. Provide planning to minimize emissions in any future development. Plan early for positive nature and positive nature impact, and strengthen your local engagement with transparent disclosure. That will have an impact on the valuation of your company, whether it's M&A or investment. There will be a cost-benefit question asked. Much of what is required will cost, but financial markets are beginning to differentiate those industries or companies that deserve capital and those that don't. Different jurisdictions have different language. Some are moving slower, some are faster, but the message and trend is clear. Boards of directors have obligations to consider sustainability as part of their oversight. Nick Stansbury, who many of you know as a fund manager in the mining industry and also now head of climate solutions at Legal & General, stated recently in a discussion regarding the changing paradigm of investing is that ESG must be at the heart of every company strategy. Coming back to the investment process, mainstream funds carry out ESG screening as standard. Any identified risks will require stewardship teams to define whether the management have appropriate plans to improve or the company just becomes blacklisted. We have to accept, rightly or wrongly, that the mining companies will typically attract the need for a review. Whether you're a CEO, a chairman, a private or institutional investor, you want to see a rising share price. You want to see the market justify the effort and value being created. Discovering new resources and developing a mine now also requires a transparency in the way that the company went about that discovery or plans its future operation. The weight of money behind a shifting paradigm investment cannot be ignored. There will be winners and losers. There will be those that choose to embrace change and those that will not. So how do we stand out from the crowd? How do we ensure the sector encourages new investment? For decades, the universe of funds investing in the sector has been limited to the ebb and flow of the price cycle. It's different this time. It's fully recognized that copper, lithium, nickel, etc. are needed to support the technological advances to decarbonize the world. The shift of funds to ESG and sustainable themes is a huge opportunity. Impact funds generally are much longer term in nature than the traditional funds that we've been used to. Mining is a central theme of most sustainable frameworks. Impact investors, by and large, are permitted to invest in mining. They just choose not to. In virtually all my conversations with these groups, there is a common hurdle. Give us a means to credibly track ESG, and we can start to invest. It won't happen overnight. It's not an immediate fix, but the change in the valuation of this sector is dependent upon bringing in new pools of capital. But this isn't just an exercise in maintaining the status quo. This is an opportunity of epic proportion. Imagine if this small industry of less than 3,000 public companies accepted the inevitable and started to disclose in a standardized format that facilitates internal and external discussion. Acknowledged that the credibility gap and therefore encouraged a third-party assessment to give investors and other stakeholders the confidence and the conviction needed to begin to believe in the changes taking place. This is already happening. We are at the early stages of it. There is a desire by mining companies and governments to encourage their mining companies to earn a social license by credible disclosure. Imagine, though, what the results would be looking 2 years, 3 years ahead. Conviction would increase. Confidence in the sector would grow. Cost of capital would likely reduce. Long-term investors, such as sustainable funds, would start dipping their toe into these companies. Labelled and green bonds would open up new and lower cost of finance for a multitude of different projects. Management would be incentivized to perform relative to their peers. Cost efficiencies will materialize as less energy is used, more efficient working practices are employed. New investment in technology would have impacts on business functions, environment, and social. The industry would begin to inspire younger persons for employment, and local stakeholders would have a transparent means to engage with operators. I'd also like to say that I also believe, as a result of some of the things that we've been discussing this week, is the differential of pricing of commodities is going to happen as a result of ESG, whether it's inclusion through blockchain or other means. It's going to happen. There's going to be discounting in commodities and products that are not being accredited in an ESG fashion. This is not naive small talk, but it's a business imperative. Imagine the alternative, where investment portfolios, government policy and industry move on without us. How long will licensing negotiations extend without a credible dialogue with NGOs and policymakers on climate impact? It's only a matter of time before voting of directors extends right across the spectrum to force change based on ESG metrics. We are already experiencing early evidence of the positive impact credible disclosure can make. I was encouraged nearly 2 years ago by leading stakeholders of the industry to find a solution to Digbee, to disclose ESG. Digbee makes disclosure easy. It provides a means for all companies to be ESG accredited following a third-party assessment, and it provides a means to communicate this to all its stakeholders. Mining offers so much to this world, but for it to be really beneficial, it needs to find a level of credibility with which society, stakeholders, and investors can rely upon. Digbee provides its frameworks for free to any company. The blueprints are there for all to disclose. Our goal is to encourage the whole sector to get on board, prove this industry embraces a more sustainable future, so that our children can demonstrate that the actions we took today encouraged a vibrant, attractive, and highly valued industry in a new world. Thank you very much.